One of the key tenets of the Aristotle investment philosophy is the focus on understanding and investing in what we believe to be high-quality businesses. Many times we're asked, what defines a high-quality company, and how do we go about identifying these types of businesses? While the definition of quality may differ amongst our peers, at Aristotle it starts not with a quantitative screening process, but rather a qualitative understanding of individual businesses and identifying those with unique attributes we believe to be sustainable and difficult to replicate over time. As part of the investment team, our day-to-day focus is on learning about and understanding great businesses on a global basis and trying to determine what allows certain companies to maintain or even improve upon their competitive positioning longer term. In many cases, quality is unique to each individual business and can be measured in many different ways. However, there are certain key attributes we do look for during our research process. These can include things such as high and growing market share position, a leader in a consolidating industry, expanding operating margins, consistent free cash flow generation, as well as predictability and the ability to do well during times of adversity. We also spend a great deal of time trying to understand a company's position within the value chain of its industry and whether they are positioned to garner the biggest benefits and potentially attractive returns over time. In our experience, quality businesses that possess some, if not all of these attributes, tend to generate higher relative returns on invested capital over longer periods. An example of what we believe to be a high-quality business would be the Home Depot. Over the last several years, the company has been able to consistently generate higher sales per square foot, profitability, and cash flow than its primary competitors while also continuing to gain market share. In our opinion, this is due to factors such as its advantaged store locations, which is difficult, if not impossible, to replicate, its strong competitive positioning with the lucrative pro customer, and having a business model that is relatively sheltered from online disintermediation, unlike many others in the retail value chain. Another example would be Marietta Materials. On the surface, this may just look like a commodity rocks business, but in our opinion, a more in-depth review reveals a quality business that has significant barriers to entry due to quarry permitting restraints, surprisingly strong pricing power across economic cycles, a management team that we believe has proven adept at deploying capital as compared to its peers, and is a leading company in an industry that continues to consolidate. Lastly is Compass Group, which is a global provider of outsourced food and support services. We believe this company, over a number of years, has built an enviable scale advantage which has allowed the company to consistently gain market share and generate industry-leading operating margins. Its business is very consistent and tends to do well even in times of economic adversity due to the long-term nature of its contracts and high retention rates with its customers. It is also a surprisingly capital-light business, which can afford it high and consistent levels of free cash flow, which can then be used to reinvest back into the business as well as return excess capital to shareholders. While these are all very different companies, each having their own unique attributes, it does provide some context of the types of differentiated businesses we look to identify through our investment process. It is this focus on analyzing and deeply understanding individual businesses rather than simply buying and selling stocks, which we believe allows us to identify quality companies positioned to prosper and withstand the test of time that might not be fully recognized by others.